This is the Retirement Solution Podcast with financial advisor Jon Hicks, founder of J. Hagan Capital.
If you watch enough financial TV, you'll start to notice a pattern. There always seems to be a forecast and then a strategy built around that forecast. And Fox Business was asking wealth manager Eddie Gabor what he's expecting from the market over the next few months. And this is how he responded.
You should expect a summer correction, but I would be buying those hand over fist because the biggest thing I've seen here is people have missed this rally. It's been really hated. They continue to ask how much higher can it go? And this is a real earnings story. These aren't just companies that are fly by night. And if we get a gift of another summer dip, we will buy hand over fist because I think by the time we get to the end of the year, markets are going to be much higher and we're going to surprise to the upside on growth economically as well as earnings projections.
So again, that was wealth manager Eddie Gabor. Buying hand over fist, John, sounds simple.
Yeah, that's a different viewpoint than Eddie's had in the past. In the past, I've heard him a little bit more doom and gloom. So that's interesting. It's interesting. So, earnings, we have had some estimations and guesstimations, that earnings may be pretty strong, after the second quarter. We'll find out. We'll find out what that really looks like and just how earnings season is going to pan out. But that is interesting because, the biggest thing that he's talking about, buying hand over fist on a dip. Mm-hmm. The two things about that, right, it's kind of like it's market timing, right? It's the one thing that they try to tell all of us is a big no-no.
Right.
And you have to wonder, because, I've read a lot of really heady, genius investor stuff, and they talk, no, you can time the market. You can at least time how much you're willing to pay for an investment, whether it's an exchange-traded fund or a stock or whatever it is. You can time when you get in. Are you getting in when it's cheap or expensive? And I think that's where Eddie maybe was making a point. He thinks that the market's going to come up. I don't know. The question is, Heather, how much should we be willing to gamble on that? Basically, it's like a lottery ticket. Someone's saying, hey, here's a forecast. I think it's going to be really good. And you're like, well, okay. Well, how much am I going to gamble on that? How much am I going to wager? How many lottery tickets am I going to buy for that in case it pans out? Versus, hey, how much do I need to make sure I'm protected? How do I be certain that if I do want to retire in the next 3 years, or I'm already retired, how can I be certain that I'm not risking too much to where I can no longer retire when I want or retire the way I want? And that is the bigger piece. Because I think every single day, depending on the top of the hour or the bottom of the hour that you watch CNBC or Fox Business or whatever it is, someone's got their crystal ball out and they're trying to prognosticate. What was it? Karnak, the amazing Karnak? Is that what Johnny Carson used to call himself?
I don't remember the name. I remember the hat and the crystal ball. I don't remember his name.
Pull out the hat and he would have the crystal ball. Mm-hmm. The amazing Karnak would come up with unbelievable observations of astounding normality. Nothing special. But that's the whole idea about, forecasts. So it's, we'll see how it goes. We'll see how it goes.
Want to quickly remind you, if you have questions regarding the financial news that you've seen, forecasts, or other things at J. Hagan Capital, they're here to help you get some answers to those questions. You can reach out to us by dialing the number 502-317-0840. You can call or send a text, 502-317-0840. You brought up the idea of market timing. We don't want to be doing that, trying to jump in and out of the market. The obvious question is, why is that difficult for so many investors, particularly retirees? We could unpack that a little bit. I think that the bigger question that we need to be thinking about right now is, what do we need to know about our current market circumstance versus where we are, just getting close to retirement or already in retirement, and how do we properly manage those two spaces together?
What a great point. So the two things we really need to hit on, number one is the reason that market timing is so difficult is you have to be right twice. You have to be right the first time on when you get out, right? So it's like, there may be a correction, there may be whatever. Because even Eddie said that, he's expecting a summer downturn. So the question is, if you're trying to market time, you got to be right first on when to be out. Now, here's the secondary part. And this is what happened to so many people after COVID. So many people did not make the money on the COVID rebound because they didn't get the second part right. The second time you have to be right is when to get back in. Mm-hmm. And that's the problem, right? So let's assume you get it right. Let's assume that, and let's just go back to 2020. Let's assume you get it right before the market just absolutely went off a cliff when they announced COVID in March of 2020. Imagine that you had been out sitting on the sideline, okay? So you did that right. You got all that right. But the question is, how long were you out before you decided to get back in? Because the two major things, number one, you got to get it right twice. You got to get out and you got to get in. The second thing is the best days of the market. The best days of the market are often hidden right at the very beginning of a rebound, right? I think, and I got to look up at the statistic here, 76% of the market's best days, I'm going to say this again, 3 out of 4, 76% of the market's best days land in a bear market or in the very beginning of a recovery phase. Okay. So if all of a sudden you're looking at you got the amazing Carnax crystal ball and it tells you to get out and you did that and you have no losses, then the next question is, okay, what are you looking for as the signal to get back in? A lot of people say, well, John, when it gets back or when it gets to that point, but what does that look like? And I think it was the Supreme Court said, we'll know it when we see it. We don't know exactly how to put this in non-legalese, but we won't know it until we see it. But when we see it, we'll know. That's when we'll know. And so that's the point. When do we get back in? Because most people, and I've talked to them, I've talked to thousands of people since 2020, and most of them said, yeah, hey, I didn't get too much of that punch in the face, but man, I didn't get that rebound. I didn't get that, when all those tech stocks just went through the roof and just kept on going and kept on going and kept on going, I wasn't in that. So that's the first piece. The second one is it's those bad days. Those bad days freak us out. It's when we often sell. So we're out, and then we don't get back in to get that rebound in the future. And then now, this is such an interesting period of time, right? It doesn't matter what anyone's political affiliation is. If you look at the current administration, the way that Trump does things, Trump can move the market in a nanosecond. He can do it by saying, hey, I was on a conversation yesterday with President Xi, didn't like what he had to say, so I told him to, he could go do whatever he wanted to do. And all of a sudden, the media will pick up on that and the market will be up 9% or down 9%, just depending on the day. Only Trump, he says, the only president in the history of the United States that can make a comment and it can move a market either direction on the drop of a hat or in this the drop of a soundbite, right? Mm-hmm. And so how do we know that we're getting in or out at the right time? That's a big thing because a lot of those rebounds happen because he has said something. We have no idea what he's going to say. Now, I think the one thing that every educated human being alive, including the president's own son, Donald Trump Jr., says, dad's dad. And we don't know what he's going to say. We feel pretty confident that when he says it, it's going to have impact and meaning for things that we want to do, but we really don't know. And I found that to be really interesting because when that's the case, why would we want to be timing things? So if we do this correctly, here's what we want to do. We want to get the timing right once. When we're planning for retirement, we want to get out of the market timing elements. What we need to do is we need to be correct one time when we're creating that portfolio and delineating and finding out how much of it do we have to protect so that we can stay retired and live the way we want. Basically an income floor. It doesn't matter what products you use to create the income, but we want it to be sustainable. We want it to have a long-going concern. We want that income to be kind of methodical, whether it's coming from Social Security or your pension or an income annuity or rental income that you've had for 10 years in a row and you can just rely on it. It just does the right thing. Those are reliable income sources. We have to have that to stay retired. So the only thing we have to figure out is how much of our portfolio, let's just use $1 million example. If we've saved $1 million, how do we protect enough of that so that even if the market does go down and stays down for a while, how can we be certain that we don't have to unretire or go back to work or find a different income source or just live at a lower standard of living? Because we don't want to do that, guys. That means that we messed something up in the planning phase. So what we need to plan for is, number one, how much of it do we need to protect so that we can stay retired? And then we need to figure out where's the income going to come from. Can we rely on Social Security? Yeah, I feel like we can, at least at this date and age. Now, I'm going to be 50. So for me, I may have a little bit more question marks on the tail end of my retirement journey. And my kids, I don't know what they're going to see. They're 16-year-olds and 11. I don't know what their Social Security is going to look like. But if you're in your, late 50s, early 60s, 70s, I feel pretty confident Social Security is probably going to be fine for you. So we can rely on that. Well, what other income do we have? And most people don't have quality pensions anymore. So when we're looking at that, where's our income going to come from? Because if we can't get it all from Social Security and pensions, which are two often guaranteed or very sound income sources, where's it going to come from? If we're pulling it from our portfolio, that's why we can't have big portfolio corrections. And people that say, well, John, what about dividends? Well, great. So if you're getting a 4 or 5 or 6% dividend stream, fabulous. But what if that underlying equity goes down 45 or 50%? What are we going to do mentally? How are we going to react emotionally to stay with that anymore? Right? That's the whole thing. And I talk to people, all the time about UPS stock. UPS stock, unfortunately, over the past 5 years has lost nearly 50% of its value. Now, it's maintained its dividend for the most part, but it's lost 50% of its value, right? So the question is, where is that income going to come from? That is the second part of the plan. How much do we need to protect? So we make sure we get it right. Number two, where's the income going to come from? And then lastly, at least of the big three, how can we put more of that and keep more of that in our pocket and not have to give it all to taxation or give a tremendous amount to taxation, right? If we do those three things correctly, we really only have to time, and it's not market timing, we only have to time things once when we decide to implement that plan, right? And it doesn't matter, in my opinion, mostly about products used or stocks used or bonds used. That doesn't really matter. What bucket is it in? Is it in the is it done for the protection goal? Is it done for the income generation goal? Is it used for the growth part to defeat inflation in the back end? That part doesn't matter. So if we get the right plan, and what we're saying is, if we get the right plan together, what Eddie said by trying to forecast won't matter one stinking bit, because we will already know, hey, we're protected. We get our income. If it's a great period, sweet, we'll automatically make extra gravy from that. If it's a terrible time, hopefully it comes back more quickly. But realistically, our income was still fine. We know that we're protected and we're being tax efficient. Guys, that is what we need to be thinking about, instead of the next amazing Karnak with his crystal ball trying to tell us what we should do next.
Let's get to work helping you figure out your own personalized retirement solution. The number you're dialing is 502-317-0840. You can call right now to schedule a time on the calendar to start the conversation with Jon and his team at J. Hagan Capital. 502-317-0840. You can call to set a time on the calendar or just text that same number and we'll text you back a link so that you can go ahead and schedule an appointment right there from your phone. You can text the word plan again to the number. It's 502-317-0840. We're also online. You can find us anytime at retirementsolutionradio.com or the number to dial 502-317-0840. Why is it that even the most successful just can't seem to ease up, unclench, and relax for retirement? Is a question that you battle regularly, Jon Hicks. I want to bring up this article that I read on marketwatch.com because it is baffling, but I feel like you're going to hear it and you're going to be like, yeah, tracks. So this guy, he's 71 years old. He wrote into an advice column on marketwatch.com. He is retired. He has $2.7 million in an IRA, $470,000 in stocks, a pension that pays him $4,000 a month. His Social Security also pays him $4,000 a month. His house is paid off and worth $750,000. And he has a part-time job. And he says he cannot relax because he's worried about running out of money. And one hears this setup and you're thinking to yourself, wow, this guy has got it good. He is living the high life. And he's standing here going, nope, I am stressed all the time.
Absolutely. The amazing thing is a lot of folks have a really tough time trying to figure out how to bridge the gap or the difference between I've been working every day, putting all this money into my 401k, growing all this big pile of money, to go from there to all of a sudden a psychological shift of now I need everything that I've been doing to end. I'm not going to be feeding this beast anymore. And instead, I need it to start sending me money. Instead of me feeding it, I need it to feed me. And the craziest thing is that, Heather, it doesn't matter if someone has saved hundreds of thousands or millions or even, not a joke, tens of millions of dollars.
Yeah.
It just changes everything. It's not a financial issue, although it feels like one, because it's always about money, money, money in our head. But believe it or not, it's a psychological issue. A psychological issue because all of the things that we've been doing for the past 20, 30, 40, 50, some of us 60 years of work and putting money away and waiting for a rainy day to use it or waiting for a retire. And all of a sudden, we're disrupting that 40, 50, 60 years, all because things are about to shift. So here's a crazy thing. Do you know, and very few people would know this, do you have any idea who Hetty Green was?
No.
Oh, it makes sense. She passed away in 1916.
Oh, but wait, no, I think I do know who Hetty is. Please continue.
There we go.
Okay.
Hetty Green passed away in 1916. She was considered and called the Witch of Wall Street. She was one of the most wealthy, if not the wealthiest female in the world when she passed away in 1916. She was worth supposedly a little over $100 million back then, which today would be over like $3 or $4 billion. Here's the crazy thing. She was called the Wicked Witch or the Witch of Wall Street because she was notoriously so frugal, so crazy, so bent on saving pennies that frankly, it destroyed her life. So most people don't know the story, but I can't remember what year it was. She had a son. I think it was her only son. I think his name was Ned, if I'm remembering the story right. Well, Ned had an issue with his leg. So even though Hetty Green was an unbelievably wealthy person, she went to the free clinic with her son. Free clinic with her son to have his leg looked out. Here's the craziest thing. They told her, hold on, when they found out who she was, Hetty, whoa. You got all this money. This is a free clinic. You're going to need to pay. She ran out, didn't pay the bill, and started doing the medical procedures on her own. Here's what happened. Her son ended up getting an infection and ended up having to get the leg amputated. Now, the reason I'm saying all this is because even though this is a crazy, outlandish story, it happens every day because it is not financial. It is psychological, the things that happen to us as human beings. So this is a lady who wanted to be so frugal. She was so worried about all the money things that she basically caused, in all honesty, she caused her son to lose his leg because of being so mentally unready for this concept, right? So this is what happens to all of us when it gets to retirement. All the things that we've been doing, the working, putting money away, it changes, and now we need to pull from it. And for the first time in our lives, we start to freak out. We start thinking, did I save enough? Because every month, the cost of beef keeps going up. The cost of gas may keep going up. The cost of oil, all these things keep going up. Airline tickets, vacations, and that's not even including just cell phone bills, more taxes on things like communications and Federal Trade Commission stuff. It keeps adding up. And guys, it is a mental exhaustion, right? So when people say, oh my gosh, I just don't know what I'm going to do next, I'm freaking out. I see it all the time, every day. And so one of the biggest and most fundamental things that any skilled and holistic advisor can do is show people the actual math and to go ahead and try to put to bed some of those biggest fears. Because sometimes you have to see what would happen, what would be the worst case scenario at this point. And when some people see, like the gentleman we're just talking about, $2.7 million in this, pensions, Social Security, all those things, in his mind, his whole point is, but how do I know? How do I know it's enough? What happens if the administration changes things? What happens if Congress changes things? What happens if there's a flip-flop in a midterm? What happens long after that? What happens if another party comes in office? What happens if we have a geopolitical nightmare? What if we don't, do this, do that? And we just all of a sudden get flummoxed and it causes us to make poor decisions. But the craziest thing is there are 3 things that every single one of us can do to not only feel better about things going on, to actually live life in the next paradigm, which is the paradigm of being able to retire. Number 1, you have to do the math. You have to see the math on paper. Number 1, how much of your money is protected? How much income can it create? And what is the likelihood that even if there's a down movement in the market or inflation keeps going crazy or interest rates, the whole point is you want to stress test it just to be certain that you have 9.9 out of a 10 scale of being able to hit your goals. So mathematically, number 1. Number 2, you want to know where the income's coming from. Right? So whether you're deciding to work on some crafts and sell them on Etsy, or you're wanting to go flea market and find, the diamonds in the rough and find a $200 credenza that you finish up and you can sell for thousands of dollars, whatever you want to do, part-time work, pension income, dividend income from your portfolio, all those things, you want to know where's that income coming from. And lastly, you want to make sure, how do you keep it away from the government? How can you know if you're going to generate $50 or $60 or $80 or $100,000 of income? How can you know that you get to spend it and it's not going to go for more tax bills or just more bills, right? So that is what a skilled holistic advisor should be doing. It should be based on a process, not on a product. I have rarely, if ever, seen products fix people's issues when it comes to psychology, but I see math fix it every single day. If we've done the hard work of saving the money, and then we've done the second hard work, which is using the plan and the procedures on how it gives us that money, guys, we can basically relax every day knowing our floor of what our income should be in retirement, and then knowing if we wanted to blow it out, and lift really high off the hog for the first 3, 5, 7 years of retirement, we can know what that looks like too. And if we do that correctly, it's really hard to overspend, but it's all about psychology. This is one of those things that even if someone's been awesome at saving money, they've got millions of dollars sitting in a bank account or in their 401k or in their IRA accounts. This is where it is really good to find out, how do you take that big old pile of cash and how do you turn it into a true plan and a process to not only give you money for you to live off in retirement, but allow you to do all of the things that you want to do. And what I tell my family too is, listen, guys, we can't do everything, but there's a chance that we can do most things we want to do if we plan well for it. That is a life worth living, because we get out of the fear, out of the psychological parts of things, and into the real life of the math, which is easy to compute. We can all do that, but we have to start at the phase one first, which is finding out what we really want to do and getting to that point.
Of course, Jon and his team are here to help you with that math. Reach out. Our number is 502-317-0840. Call us right now to set a time on the calendar for an initial no fee, no obligation phone conversation with one of our advisors. 502-317-0840. You can also go to retirementsolutionradio.com. Thinking about the psychology of it all, the story you told about the woman, the Witch of Wall Street, somebody listening to that story is going to scoff. I would never do that to my child or my grandchild. I will take care of my family. And to that, we say, of course, you would never do that to your child. But think about this, dear listener. Turn the mirror on yourself. What are you doing as far as your own health deprecation? Because I know that's another conversation you've had to have with people, Jon.
Absolutely. Sometimes it's as simple as, go getting insoles for your shoes. And I know they're expensive, guys. I mean, really great places, they're $300, $400, $500 for really good orthotics. And people won't spend that, amazingly enough, when we talk to them and they realize, oh my gosh, I do have enough money to do that. And they get those new insoles for their shoes, their back pain goes away. They feel like moving around more. They feel like hanging out with their grandkids. They feel actually like going to that ball game to watch their grandkids play, simply because of a $400 or $500 or $600 investment that they've been unwilling to make in themselves because they didn't feel like they had permission to spend it. That's what really great advisors can do. They can help weed through, hey, what are great expenditures or even investments even into your health or your opportunities or your bucket lists, as opposed to just looking at everything as an expense. But I see it every day. People just being, unhappy or ill content in retirement because they don't realize that they should have permission to spend on those things. Those are the biggest pieces of the puzzle, where even great savers and people that are even good with investments, they really need to get a second opinion, a second set of eyes on things, so they can see, oh my gosh, I see what you're saying, Jon. I've got 4 pairs of shoes. And even if I spent $600 on each 4 of those pairs of shoes for new insoles, that's less than $2,500, and I would actually live my life without pain, and I'd actually be more mobile. Yes. Or maybe going downscaling or changing homes from a 2-story where you got to go up and downstairs every day to just a ranch, or maybe a patio home, or maybe find those things that improve life. But guys, those are not expenses. Those are investments in yourself. And what you want to find is an advisor who just doesn't talk about investments. It's what can those investments do to actually improve the quality of your life. That's what it boils down to. But that's why it's always a process over a product.
We have never shied away from political nature of things in this country, not because not one side or the other. It is what it is.
That's the whole thing. It doesn't matter, what anyone's belief system is. The greatest thing about this country is that we're all entitled to have those beliefs. The question is, which of those convictions should we act on? Which of those things can we control? And then which of the ones can we not control? The things we can't control, we probably shouldn't mess with.
That's right.
The things we can control or put our own personal economy in that, those are probably the better things to focus on, realistically.
One of the names that we have often brought into this conversation, Jon, is Warren Buffett. We usually don't bring him up in regards to politics, but this one we can't let fly by. And actually, this dates back. This goes back to 2011. Warren Buffett was on CNBC, and he threw out this idea, half joking, half not. And I'm here for the not joking part. Warren Buffett's idea about fixing the deficit. And he says he's got the solution, and it's not that complicated. This is Warren Buffett.
I can end the deficit in 5 minutes. You just pass a law that says that anytime there's a deficit of more than 3% of GDP, all sitting members of Congress are ineligible for re-election. Now you've got the incentives in the right place, right? So it's capable of being done. And if you guys can't get it done, we'll get some other guys to get it done.
Fired. Everybody's fired. Everybody out of the house.
Isn't that crazy?
Yeah.
But do you know what, Heather?
Yeah.
I bet you that is 100% accurate.
Oh, sure.
Let's think about it. Let's think about that. So, that was back in 2011. And all he said was, hey, if GDP, hits a certain
3.
level, if it drops too far, then every single congressperson is no longer allowed to be reelected. Now, here's the thing. Even though the audience laughed, Buffett's point was not about accounting. It was about incentives. Because in America and all over the world, it doesn't make any difference. We're watching the World Cup in our house. And the craziest thing about it is you watch the entire world interact similarly, right? They really go for their team and they're kind of against the other team. There's been a lot of awesome sportsmanship, which I do love. The fact that the United States is being able to take this awesome opportunity to show the world, hey, we're not maybe as bad as the papers in your country say or whatever. And people are leaving and they're coming back to their countries and saying, these Americans are great. The crime isn't nearly as bad, as people are talking about. The food is a lot better than people talked about.
Ranch
and they're really nice.
Dressing.
The Americans genuinely act like they want us here. And frankly, we do.
Yeah.
We really do. I love the excitement of watching those games and realizing, wow, this was Dallas or this was Houston or this was Seattle or this was Boston or wherever it is, and seeing all of those different faces, all of those different teams represented. And the whole point is every single one of us, and coming back to Buffett, every single one of us, we act about incentives. People act when the consequences become personal.
Right.
So even if it's about soccer, if that's your team, if Messi is your guy, if Ronaldo was your guy, if Neymar was your guy, you act personally because it means something to you. But here's the craziest thing. 15 years after Buffett made that point, the deficit isn't 3% of GDP. It's nearing 1.9 trillion. That's 5.8%, nearly double the line that Buffett drew nearly 15 years ago. Nobody listening can vote themselves out of that, but the lesson still stands. We can prepare for what we can't control by controlling what we can. Think about that. We can control what we can't control by controlling what we can. As odd as that sounds, is the truth. So that's what it means. So when we're thinking about retirement, one of the things that we can control is tax structure. Now, we can't control the tax code. Who knows if the Republicans and the Democrats are ever going to vote together again in their lives? We have no idea. Right now, things are so polarizing, it's almost lunacy. But when you do think about things, the one thing I know for a fact is that there are 3 taxable buckets or tax style buckets that every one of us can use. And this is what Buffett was talking about. Hey, let's control what we can control. Incentives. So when we're thinking about what we can control, when we're worried about, oh my gosh, what is the next Congress going to do? What happens in the midterm election? What happens if, this tweet goes out this way? What happens if the market does this? All those things we can't control. But you know what we can control? The assets that we own within the 3 different tax buckets. There are 3. And we should all utilize all 3. If we don't utilize all 3 tax buckets, we're taking away flexibility, which makes no sense. We want to be as flexible as we can in retirement. We want the opportunity to take advantage when there's a fire sale on a company we really like, or there's a great interest rate on an insured or a guaranteed stock or bond or portfolio asset that we can benefit from, right? We want flexibility. So all of us need to utilize all 3 tax buckets correctly. The first one is our taxable bucket. That's the money that has our savings account in it, things like that. The money that we've set aside, money that we've already paid taxes on. It's sitting in that account. And every year we know it's a taxable account because every year we get a 1099 from either interest or dividend or whatever it is. It's kind of like a little love tap from the government saying, hey, hello there. This is a taxable account. So here's our little love note saying you're going to probably owe us a little bit of money on this. Ordinary income tax rates on those accounts. So we do want to have taxable money, but we want the right style of asset in those taxable accounts. We want the things that do not spin off a whole bunch of ordinary income. Okay. Ordinary income is the most oppressive line in the tax code. So interest income in a taxable account is the most oppressive income in the entire tax code. Think about that for a minute. What do we typically have in our taxable accounts? CDs, money market. Well, guess what we get every year? That little love note from the government basically says you owe us money from these assets, the most oppressive part of the tax code. So taxable bucket, we can control the assets in there. Tax deferred bucket.
Let me jump in real quick.
I was
going to jump in real quick just because as people are listening to this and they go, Okay, help me, John. How do I get this figured out? Want to let you know that you can call or text our office and set a time on the calendar to start this conversation with John and his team. That number to dial, 502-317-0840, 502-317-0840. You can call or text us right now. All right, you were saying bucket number 2.
Yeah, so bucket number 2. So we can put the right assets in that taxable bucket and potentially pay very little or almost no taxes on it, right? Because if we want things to earn income, if we want safe assets to earn income, it'd be better to use those in the tax deferred bucket, which is the middle bucket. We call it the middle bucket. Because we know no matter what, we have already gotten a tax break for that money being in there. Whatever we pull out of that bucket is going to be taxed at what level? Ordinary income tax rates. Ooh, so we already know that those assets are going to be taxed at an ordinary income tax rate. So why wouldn't we have those income producing assets that it's the most oppressive part of the tax code? Why wouldn't we go ahead and have those in that bucket? Think about it, Heather. It makes total economic sense. So even though we can't control what Congress does with tax legislation, we can control what assets we're paying different tax rates on. That is almost as powerful. Almost as powerful. Does that make sense?
Yes.
No, I see you scribbling frantically, and I love that. No, that's the whole thing. Most people, this is the part that's lost on them.
Yeah.
But it is literally one of the most simplistic things.
Okay.
We do not want to pay tax rates on things we're not obligated to.
Right.
But that doesn't mean we don't want those assets. I do like having some fixed income assets in my portfolio. I do like the concept of having guaranteed income, whether that comes from a pension form or an annuity form or an insurance form. I don't care what it is. I do want something that is secured for an income structure for me in the future. So we know some assets we're going to have to pay ordinary income on. Why not put them in that bucket? But that's not what I see. I see the majority of people coming into my office and they're getting ordinary income, interest income off of their taxable account. That is the failure. They're not controlling what they can control, and it's forcing them to pay more taxes than they need. And let me give you an example. There was a couple that came in a few weeks ago, and they had millions of dollars in their taxable account. Well, they were a little bit conservative. Now, they had tons of money overall, but they had millions in a taxable account, but it was all earning bank style interest. And I asked them, out of sheer curiosity, why do you have all of these assets that you could get a little bit more of a tax break from by doing other assets? Why do you have them in these things? And they said, well, we just want safety. And I was like, fine. Do you know things exist like principal protected notes, insured structured notes? There are some insurance style products that exist that you can use where you can actually turn that income amount into a capital gain amount just simply by the holding period. And if you do that, you can still have a guaranteed safe asset. Well, they're not all guaranteed, but you can have a safe asset that produces income like a CD or like an annuity or like a fixed income instrument, but you can actually not pay ordinary income taxes on it. You might be able to pay capital gains on it. They were like, I had no idea. What we realized in doing the math on the few million bucks they had there, they were potentially going to save about $160,000 a year simply by adjusting those assets into a different part of their plan. Not getting rid of those assets, just putting them in a different bucket and using that bucket for other assets. That was the crazy thing. Hundreds of thousands of dollars, guys. It's real. So that middle bucket is tax deferral. We want to get it right. The assets in it, because that will dictate then the tax bill on the way out. And then the third bucket, which is basically what we call our growth bucket, and that's usually the tax-free bucket. We want to let money get in there and compound unfettered for as long as we can. If we're around for another 20, 25 years in retirement, we would like to really never have to touch that bucket for 20 to 25 years. That gives it the most time to grow, and potentially have zero tax consequence, not only for ourselves, but maybe even for the next generation. That would be incredible. You can use Roths, you can use some other trust structures, but you can also use some insured type accounts if you wanted a little bit more safety net. There's no right or wrong. It's just those are the elements that we do. Getting those three things right, it doesn't matter what Congress does. If we get those three buckets right for us, we control what we can control. We can effectively control our own tax legislation, but that's only if we get it right. If these are the things that you've wondered about and your guy doesn't talk about, that's why you should call us. That's the reason, because you don't know how to do it and your guy just doesn't do that. This is exactly what we do. We're controlling what we can control, which is utilizing this information to help our clients.
So for the many people who are just seeking some clear and solid advice, let's boil down some things about some of our most basic savings vehicles. You listening to us on the radio right now, you very likely have a 401k or an IRA. Maybe you've got both. I have both because that's the kind of crazy life I live. Getting wild over here, John.
Of course.
So for many Americans, 401ks, IRAs, very standard retirement savings vehicle that many of us utilize. Both of these can hold a mix of tax-deferred and after-tax money. In a 401k, there is a plan administrator who keeps track of this. So that would be where your 401k is held. There's the Fidelity, Charles Schwab, or John Hancock, wherever your 401k, that's the plan administrator, correct?
Yes, correct.
Okay, all right. But in an IRA, your individual retirement account, you're the plan administrator. So already there's lots of pressure on you to save because most of us don't have pensions anymore. So now you become your own administrator. So it's on you to know which dollars have already been taxed or not and how to manage it all. So I have never heard of an IRA whisperer, but we have one here on the show today, John. Her name is Denise Appleby. She was on Morningstar recently talking about things we need to know about this space. This is Denise Appleby.
The primary reason for saving in IRAs is so that your earnings grow tax deferred and you pay taxes only when you take distributions of those amounts. It's about saving on taxes, and you lose all that benefit if you don't keep track of your after-tax amounts. You know, the tax preparer use what you give them. So don't assume that they know. Make sure you tell them about every type of transaction that occurs within your IRA.
Which is not easy to do, keeping track of all these transactions. And this is where many people get tripped up, John. So when doing a yearly tax review for clients, how do you identify things so that there's no confusions or costly mistakes down the road? And what are the mistakes that could happen? I guess that's where we start.
Yeah, so one of the big things to kind of understand here, Denise, what she just said, I see this a lot more often than I thought. So
really?
Many times, especially when we've been very successful at saving money and making money, we want to go ahead and save some of that, right? So what she's talking about is many times we make contributions to IRAs, but because we maybe made too much income that year, or for whatever reason, however we filed, the IRS does not allow us to take the deduction for that IRA. Now, here's the point. They don't send us a letter and say we're disallowing it. The mathematics that they have, it just didn't happen.
Okay.
And if it's not on what they call an 80, and this is why it gets so complicated, right?
Oh my God, here come the form numbers. If it's not on an 8606 form, right. And so how many times in my life have I gone through my own tax records to verify that my 8606 form was filed and that it was accurate? I'm going to tell you, never. I have never done that. Although I know that is what we're supposed to do. It's just not one of those things that I pay attention to. But what Denise was saying happens all the time. People put money into an account. They don't get the tax break they thought, but over the years that money grows or does whatever its thing is. And then they find out when they pull that money out, they didn't get a tax break in the front end, and they actually do have to pay taxes on the way out. Heather, that is a double taxation on the same money. And here's the point. The IRS or the government, they'd say, well, it's your fault. You didn't check out that 8606 form. You didn't do that. This is the onus of all this is on you, Mr. and Miss Taxpayer, Mr. and Miss Saver, Mr. and Miss Worker, Mr. and Miss whoever you are. This is your problem because no one wants big government. So we don't have people in cubicles anymore to do all this stuff for you like they ever did. The point is that the onus is on us. And if we don't pay attention, and or if we don't know, or if we don't know to pay attention, it literally can be double taxation on huge sums of money, like seriously, like hundreds of thousands of dollars. So there is so much to be said about making sure that our tax plan in general, when it comes down to retirement, is done correctly. And this is kind of where I always say, hey, listen, most of us, when we have our money invested with our 401k company or with our IRA custodian, whatever it is, most of those folks are not bad, maybe even pretty good at money management. They're pretty good at say, hey, we're going to buy the S&P with this amount of money. We're going to buy some bonds with this amount of money. We're going to put this in a growth fund. We're going to put this in a value fund, and we're going to get this all right. Well, we see our performance on our statements. We're going, they must be pretty good at retirement planning. Well, ladies and gentlemen, all they're really may be good at is money management. But that retirement planning, that's where most of us, even if we've had good performance, this is where we want to seek out a holistic advisor who understands the tax pieces of the puzzle. It is common on any given week where I will look at all of the people that are
advisors have met with and see, no joke, millions of dollars of potential tax savings, not because of anything miraculous or magical that we do, simply what they're doing today. And if they just implemented the simplest type of tax design that we look at, which is not invasive at all, it's just putting the right assets in the right buckets when we want to pull the money out. That alone, millions of dollars on any given week when I'm looking at all these plans. And guys, that is what I see most people not having. They may have wonderful accounts at Charles Schwab or Vanguard or Fidelity, and that's great. Those are great money managers. But how do you make sure that that money that's being managed puts the most in the back end into our pockets, right? Which means after taxation. So what Denise was talking about, I see all the time. We assume that someone's doing that job, but that's not their job to do. Their job is to literally manage that money in that fund, not to make sure that that money is going to last or be the most tax efficient for our future. That's where I find most folks, they really do need to find a different type of an advisor who's not just a money manager, but essentially a retirement steward. Someone that can walk us through all the pieces of retirement, whether it comes to protecting what we have, creating an income stream so we can stay retired, being tax efficient, which is this one, where it goes once we're gone, so our surviving spouse, and then hopefully our heirs or our churches, and lastly, how do we cover healthcare without hopefully paying an exorbitant amount in long-term care costs? Those 5 things, if it's done correctly, guys, that is the sign of a comfortable, if not straight up successful retirement. And most people, unfortunately, don't have those things.
In the meantime, don't assume anything when it comes to what you hope people are doing as far as forms being filled out properly and all the other little minute details that come along with figuring out your financial plan. Jon and his team, they're here to do a second opinion on your savings, help you understand what's really going on with your money, your nest egg, and help you figure out a plan to have that nest egg generate income for you in retirement, tax-efficient income. 502-317-0840 is our number if you want to call and go ahead and set a time on the calendar to start the conversation with Jon and his team. 502-317-0840. I know you meet with your clients a couple of times a year. Tax review, part of this meeting process. What should somebody expect? Perhaps somebody's 55 or in their late 50s. They haven't yet met with a retirement planner. They're now thinking about this next phase of financial planning. What should somebody expect from a tax review process with an advisor like yourself?
Yeah, I think a lot of folks, they focus on, hey, how much money can I save this year in taxation?
Yeah.
And that, although is unbelievably important, a lot of the time, that's not really what we're trying to figure out. What we're trying to figure out is all the money that we've saved over the course of our working life. What do we expect that to look like? And then how can we get and keep the most in our pocket of that money coming back to us so we can live off of, right? That is the biggest issue. So where a lot of advisors and or tacticians, if you will, or CPAs, they're focused on how can I have my client pay the least amount of taxes this year? What we're looking at is, well, how can I make sure that my client pays the least amount of taxes, period?
Okay.
I don't care about this year. I'm talking about over the next 20 to 30 years of retirement. If they've saved $1 million, do I want $500,000 of that going to taxation? Or how much better would it be if only $160,000 goes to taxation and that client can keep the other $340,000 in their pocket or give to their kids or use that to pay for out-of-pocket medical expenses and or do whatever they want to do? That is big and it's very different. So often in our office, our advisor's job is to really talk to the CPA of that client and educate them on what we're trying to do and just to make sure that that is also a good game plan for that client. That's the biggest thing, right? We just focus on the piece that's very different than most tax practitioners. They're looking at, hey, how do I decrease the client's total income this year or give them those deductions this year? And we're looking at, hey, how can we keep the most money in this client's pocket or in their account so they can use it when they want to, or they can give it to who they want to. Very different planning.
Give it to who they want to, not just haphazardly handing it over to Uncle Sam, which is what can happen so very often without the proper tax plan in place.
Well, if you think about it, Heather, if we don't have a plan, the government already has one for us. It's the default plan, which means you will unfortunately be forced to give maybe much more than you would like to because it's the default plan, which we can correct, but it starts with understanding where we are and what we want to accomplish.
Let's begin the conversation helping you understand about your plan, your money, your future. It's retirementsolutionshow.com or just click on the links we've got posted in the show notes.
Thanks for listening to the Retirement Solution Podcast with Jon Hicks. Begin the conversation about your savings plan with John and the team at J. Hagan Capital by visiting retirementsolutionradio.com. Be sure to listen to John's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Incorporated is not licensed in all 50 states. To find out if J. Hagan Capital Incorporated is licensed in your state, please call 502-690-5635. J. Hagan Capital Incorporated is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. By contacting us, you may be provided with information about insurance and annuity products offered through J. Hagan Capital, LLC, NPN number 1882794.